Hi, I'm Jimmy. In this video, we're looking at Exxon Mobil Stock, ticker symbol XOM. The goal of this video is to try to better understand Exxon Mobil's business and then see if we can value Exxon Mobil stock using a discounted free cash flow valuation technique. Now, I'm reviewing this particular company because it came as a suggestion from one of the Learn to Invest members. They joined the Learn to Invest community, and then that community voted on which companies we should do. Exxon Mobil is the company that won, so here we are. Okay, so let's jump right into their business. So Exxon Mobil's business can broadly be broken into three main segments. Downstream is the largest, that represented about 80% of their 2019 revenue. Then their chemical segment came in at about 11% of their revenue. And then finally, their smallest segment was their upstream business that brought in the final 9% of revenue. Okay, now if we're curious, the upstream business is where Exxon, or really any company in this industry, it's where they drill for oil and gas. So this is where the huge drop in oil prices are going to first get hit. This is the part of their business that's they're first going to hit. And then their downstream business, well, that's where we would see refining or their gas stations, or even if we bought a quart of, let's say, Mobil 1 oil, well, this revenue would all be accounted for in their downstream segment. Now, if we were looking at the industry in general, we might also see a segment called midstream. Midstream is where oil and gas is shipped from, so pipelines, barges, things like that, and where it's stored. And Exxon doesn't seem to break out their midstream business, even though they do have some midstream, typically defined as midstream operations. They roll that into part of their downstream business. So that helps explain, at least partially, why their revenue is so relatively large in this particular segment. Then their final segment is chemicals. Now this segment is a nice complement to the other two segments. All three of them interchange quite nicely, but they all work together if they complement each other quite nicely. And then this segment also produces things that are used in things like rubber and plastics. The list goes on and on as far as what their chemicals business brings to the table. Okay, now let's look quickly at how Exxon has been impacted by the coronavirus and the obscene volatility that has taken place in the energy markets, particularly oil. So just recently, Exxon they announced their first quarter earnings for 2020, and they posted a loss for the first time in a while. And I'm sure that for many of us, this was expected. But some of that loss was tied to write-downs that Exxon Mobil had done, which in theory were just one-time write-downs. So many times analysts adjust these earnings to account for the fact that some of those impairments shouldn't happen again. So if we were to adjust this chart and replace it with adjusted earnings, well, this is what the new chart would look like. And now adjusted earnings for the first quarter of 2020 is slightly positive, although they are expected to go negative in the second quarter of 2020. So I'm not sure that anybody's too surprised that things would be negative at this point for most energy companies. Whether we want to adjust it is frankly somewhat unimportant at this point, especially since the real problem for a lot of these companies is that oil has been more than halved since the end of 2019. And we may look at this chart and say, it looks like something's wrong with this chart. I distinctly remember hearing that oil prices went negative not too long ago, yet this chart doesn't seem to show any sign of that. And if you're curious to better understand that, I actually did a video just recently where I looked at the US oil fund and I took a moment to explain how this happens. This is the correct chart for oil, but the price for negative oil won't show back up in most oil charts. If we were to look at something like Yahoo Finance, it's not going to show up, but I explain that in the video below if you're curious. Okay, but for now, let's shift back to Exxon Mobil. So let's look at some of the key points coming out of the most recent earnings report, and then we'll see if we can value Exxon Mobil stock using a discounted free cash flow valuation method. So first, clearly, their upstream business has been significantly hurt, and that has been expected. There is a huge oversupply in oil, and when we pair that with the huge decrease in global demand for oil, since much of the world's been on lockdown, well, that's really hurt their upstream business. Then second, their downstream business got hurt for the very same reasons. There's been a huge drop-off in demand for jet fuel and gasoline. Then Exxon's chemicals business, well, they actually did quite well. They had some improvements in margins, which is a good sign for their business. But when we saw this chart before, unfortunately, the gains in the chemicals business has gone a bit unnoticed since it represents a much smaller percentage of their overall business. Now, a bright note for Exxon is that they have been continuing to continue to add to their portfolio of oil and gas properties to try to strengthen their overall position so they have a better chance of returning to profitability once the markets recover, however long that takes. That's an advantage of being an enormous company like they are. Okay, now this brings us to Exxon Mobil's dividend. Right now, Exxon Mobil's dividend, their yield is about 8%, which is crazy high. And Exxon Mobil's management has stated that they want to maintain that dividend, and it's a priority for them to continue to improve that dividend. So we can see with their annual dividend history that Exxon has been consistently a solid dividend payer. And if we believe that oil is going to recover at some point over the next couple of years, let's say, well, their dividend could in fact be one of the factors that sway many investors. And I think at the current price, their dividend yield looks very, very appealing. Okay, so their dividend looks interesting and that's great. But what do we think is the fair value for Exxon stock today, and is it worth buying? Well, this is my discounted free cash flow evaluation, and I'm not going to run through exactly how all of this is done. I actually did a whole video if you're interested in learning how to do this. I've even got an Excel template that I built that I can email you if you want, but for now, I'm just going to run through the basics of what this is. So if you're curious, there's a link in the description below to the discounted free cash flow video. So first, I took my analyst estimates for free cash flow going out the next few years. Now we can see that they expect a huge dip in 2020, which is logical, and then they have free cash flow gradually improving over the coming years. To me, this makes sense. The huge dip in 2020, the fact that it's not negative, I thought it might be negative according to analysts, but I'm not too surprised because Exxon Mobil has gone out of their way to cut a whole bunch of costs on an annual basis to try to reduce their capital spending at this point. So I'm not surprised that free cash flow would be slightly positive. And then, of course, it's growing from there, assuming oil recovers at least somewhat. Then we take those estimates and we discount it by a required rate of return of 7.5%. That's been my go-to required rate of return recently. Then I used a perpetual growth rate of 2.5%. Once again, this has been my go-to number, and I believe this is a very fair number to use in the long run. That calculation gives us a fair value of the company. We divide that by the shares outstanding. We end up with a fair value on a per share basis of about $65 per share. Now, one thing for us to consider is that Exxon is sitting on about $53 billion in debt, and that's probably a bit too high for us to just ignore. So one thing we should do in this situation is adjust this calculation for their net debt. And with that in mind, we add this and we end up with a fair value of about $54 per share. And considering that Exxon is currently trading about $44 per share, well, the stock looks fairly appealing on a fair value from a DCF standpoint. And if we're curious, the difference between these two numbers, how we got to the new company value number, well, basically, we take the old company value, we subtract debt, and then we add any cash that they have. And we take that, we divide that by the shares outstanding, end up with a fair value of equity. Equity is another word for stock. So this is the adjusted value based on after accounting for their debt. So if we paid off their debt, this is what the stock would be worth. So our question is, should we buy Exxon stock today? Well, personally, I think Exxon Mobil stock looks very interesting. Based on yesterday's price, there's about a 22% or so upside from the current stock price. And to me, that implies a fairly good margin of safety. Plus, you got to love the dividend that they're paying over the long run. So depending on each of our individual portfolios, I think that Exxon could look quite good here. Depending on what the rest of our portfolio looks like, this could be a great stock to add to it, assuming we're willing to sit on it for a long time, because let's face it, oil could be down for a while. I would expect at least a few-year turnaround, or I would plan for at least a few-year turnaround before Exxon's back up and running, sort of rocking and rolling again. If that happens, then I think Exxon could be a great buy today. Now, I've seen a lot of comments of people asking about different midstream companies, and I know we mentioned that Exxon's midstream business is baked into their downstream numbers, but midstream is companies that deal with oil and gas storage and transportation. Now, many people have asked, are those good investments since there's an oversupply and that stuff has to be stored? A lot of those companies tend to be smaller companies, And one of the advantages, I think, right now of Exxon is it is a larger company. Those companies tend to do better when there's a pullback in the market. That's not to say there's not a place for smaller companies. In fact, I've done an analysis where I looked at small companies versus mid companies versus large companies to see how they've performed and which ones do well in different scenarios. I went back to before the Great Recession. If you're curious, there's a link right here. There's a link in the description below. Thank you so much for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.